hope everyone had a great holiday season and are re-energized heading into 2024. We actually started this channel last June, and we look forward to continuing the Mooney Talks Money channel for the foreseeable future. As economic environments have continued to change, it's been a great way for us to get industry-related information out to our viewers. In doing so, I wanted to kind of recap discussions that we had in 2023 and kind of give you guys an update as to where I think some of those things stand as we head into 2024. And one of the first videos that we went through together when we had our first video, we actually talked about opportunities in markets. And one of the first things that we discussed was the 60-40 strategy, right? If we look back about 12, 18 months ago, people were concerned about that 60-40 strategy. And we had discussed there being an opportunity in that strategy in particular as we kind of move throughout the end of 2023 and heading into 2024. And just to reiterate that conversation, back in June, we weren't really sure on what economic conditions look like, right? So that 60-40 strategy really provided us a little bit of downside protection in case equity markets didn't do well, right? So we talked about the potential for a recession or a hard landing versus a soft landing where, hey, economic environments look good, and what the implications of the 60-40 strategy would actually incur in that environment. Well, in the hard landing scenario, right, which actually didn't end up coming to fruition, if equity markets were to get hit, those bond positions would likely do well because interest rate pressures would be reduced, right? And they would hopefully start to reduce interest rates and those bond prices would go up in a hard landing type environment. Well, we didn't see that going through 2023. We actually saw a soft landing type environment where equities rallied. We saw broader based markets do well. In doing so, we actually saw yield curve yields come down as well. So the bond markets actually performed well in simultaneously with equity markets, right, at the same time. So that strategy, you've seen over double-digit returns in equities and nearly double-digit returns on the bond side of things. So that 60-40 strategy did very, very well in 2023, and we do expect that to continue to do well as interest rates come down, as the Federal Reserve has mentioned that they plan on doing that. The second thing we talked about towards the middle of last year was there was a pretty big rally to start the year in tech, right? So through the first 6 months of the year, we saw large performances in the NASDAQ and tech and AI stocks. In particular, the NASDAQ, one of the big things that occurred in the middle of last year, the NASDAQ actually got rebalanced, right? So the top 5 companies in the NASDAQ actually were 45% of the index, right? So what does that mean? If you invested 100 grand into the NASDAQ, 45% of that, or 45,000, would have been invested in 5 companies, right? So a pretty big concentration in that index. Well, actually, it's required that you can't have any more than 38.5% in any allocation to your top holdings. So they actually did a rebalance to the NASDAQ, and the biggest reductions to the NASDAQ actually came in Apple, Microsoft, and NVIDIA were the biggest reductions in the allocation to the NASDAQ. Furthermore, we talked about opportunities towards the end of the year, right? So tech and AI did really, really well for the first 6 to 9 months of the year. And then we talked additionally about other opportunities that were out there. In particular, like just to prove that point a little bit further, the S&P 500 through 9 months of the year, 90% of its return came from 10 companies, right? So we were looking for opportunities outside of that. And in particular, we talked about small and mid-cap companies. I'm going to share my screen just to give you guys an update on that just for the last quarter of the year. And I'll share my screen here. So through the last 3 months, right? So back when in October, when we released that call on small and mid caps, the S&P's actually done quite well, right? So over the last 3 months, the S&P 500's up almost 9%. The asset classes that we talked about, there being a little bit more of an opportunity than in previous markets, was in the small and mid cap space. So first is the S&P 400, which is mid caps. So over the last 3 months, that's up almost 12% on the year, performed a little bit better than the S&P. And then looking at the small cap index over the last 3 months, that's up nearly 15%. So for the first 9 months of the year, we saw most of the return coming in the S&P and in those top 10 companies, right? Well, the last quarter, we really saw a full-fledged market recovery or a broad-based market recovery. And really all companies started to do well towards the end of the year, right? Now, a lot of that came with the news that we expect interest rates to come down in the future, which we're quite excited about. But then not only that, but we saw the full-fledged kind of market recover and not just a certain asset class, which is really positive for the broader based economy. So that was one of the big things that we talked about in one of our talks together. And then the last thing that I wanted to address and kind of recap from last year was we talked a little bit about tax savvy investing. And one of the things I wanted to point out was even in a year like last year, where the S&P 500 does double-digit returns in the 15 to 20% range, you'll notice that of those 500 companies, 170 of them were negative on the year, right? So there was 170 opportunities to tax loss or to harvest losses if you are an S&P 500 investor. And what I mean by that is if you own the ETF, you didn't necessarily have that opportunity. But if you own the 500 companies individually, right, you could have tax loss harvested 170 of those companies and then allowed you to pay a lot less taxes in the future when you go to sell some of those companies that you've made money on. So just wanted to reiterate that conversation. And even when markets are doing really, really well, right, by owning the individual companies, that creates additional opportunities for you to harvest losses and can help reduce your long-term tax liability. So that wraps up kind of the conversations that we've had throughout 2023 in a real kind of quick video here. I believe that's kind of where those topics stand today, and I wanted to give everybody an update on those topics and kind of what we're seeing going into 2024. So like and subscribe to our channel to continue to get updates as we kind of navigate market conditions, right? Things have been changing and we expect them to change pretty substantially over the next 12 to 18 months. So tune in with us and feel free to like and subscribe below. Thanks.